This is everything you've saved over the last 40 plus years. This is your retirement savings, your IRA, your investment accounts, your 401k, everything that you've worked for, put away, done without over the years. And now it needs to last you 35 plus years into retirement. But there's a big problem with this. You have a partner in this. The IRS wants a portion of your Social Security. The IRS wants a portion of your 401k. The IRS wants a portion of your IRA. You have inflation that's going up more every year. We have healthcare costs, which are rising at 3 times the rate of inflation. And then inevitably, the kids move back home and want their half. So folks, we have a serious problem. Taxes are a big part of that. And I'm glad you're here today, because we're going to look at putting some of these pieces back together and how you can make your retirement taxes as efficient as possible, and some other strategies along that. So thank you for coming. I'm Eric Schmall. I'm a wealth strategist, and today we're going to talk about taxes in retirement and a few different strategies, some different updates it's really timely right now, coming up to some of the different tax deadlines and with all of our changes that have come up recently. And it'll show you this folder that you had as a handout. You saw a little bit about me, my bio. I'm married. My wife and I live just on the north side of East Bethel. We have 2 daughters, Ella and Ava. Their ages are 10 and 7. Well, actually, the 10-year-old turns 10 in a week from Wednesday. So that's a little bit about me. I have over 10 years in the financial services industry, from all different aspects of banking, insurances, mortgage planning, investment properties, and real estate management. So I cover a wide variety of areas in my background, and that's where I bring all that together as a wealth strategist. This is an educational workshop, so we'll be going through information. I'm not here to sell you anything or talk about products. We're just talking about the information on the changes in taxes. This second form behind my bio, this is an evaluation form, so I'd ask that you give me some feedback at the end, fill it out, and if you'd like any follow-up, circle yes on there and put some notes on times. But really, hand this in to my brother Adam, is the one that checked you in by the door. Turn this in on the way out so we can do a follow-up thank you and make sure that I'm improving on these workshops, finding out if there's any details I missed that you'd like to see more of on any future ones that we plan. And then just some scratch paper and this back page I'm not covering today, but these are other areas of topics that we cover at Freedom Strategy Group. That is, my main office is in Big Lake. And like I mentioned, I live just north of here in East Bethel. So that is our folder and our handout. These disclosures are letting you know that I'm not a CPA, I'm not an attorney, I'm not representing the IRS or the Social Security office. So our goals, we want to help understand what changes are going on, how they can affect you, and where you can find the efficiencies, where those changes are going to be for planning into the future. A lot of times what I see with CPAs that my clients are working with is they're so busy focusing on what happened in the past, what happened last year. Well, there's some things that you can do with that, but really where the biggest gains are is that forward-looking, planning, going out, what's going to happen the rest of 2018, 2019, what do you want your world to look like? And we're going to identify some of those different tools and strategies and ways that you can maximize your efficiencies. And this bottom note here on nothing political, we're not going into debates on what things should be or how we want them to look. We're just focusing on, we have 1 hour today, and I want to stick to that, get us out here right on time at noon. So going on what is in place right now and how we work with it. We know things are always going to keep changing in the future. So if you have confusions on taxes, don't worry, you're not alone. It can be confusing. They're changing things all the time on the tax code. And right now, that's what it brings us to with some of the new brackets on how they look. We have the taxable income starting out at the 10% and going all the way to 37% on the ordinary earned income. Now what this is showing, maybe if some of you have ever done any of the paper filings where you're doing it by hand, Otherwise, if you're using a CPA or tax software like TurboTax, a lot of these calculations are going on in the background and you're not seeing how it's affecting it. But it's the thresholds that you're passing along from one area of bracket. It's the income that goes over into that next bracket. So if we're looking at this $19,005, anything over that is jumping into that next 12%. So it's not everything, it's the dollars after that first pool of money is how those progress through. And this is another way to think of it. We call this the tax map. And I'll show you some software that we use. Everybody's is a little bit different once you put your numbers in there, how it breaks down. But this is showing us how the different levels go from 10, where we have another big jump on that 12 to 22%, and then out 24 to 32%. Those are where some of the biggest advantages are that you can take with efficient planning and say, how much does that next dollar cost me? Where am I pulling money from? Is it coming from another IRA? Is it a different 401k account? Do I use savings until the end of the year because I want to avoid getting taxed in the next bracket? Those are some of the things to consider with how these big changes happen. And this is just identifying where two of the biggest jumps are once you start getting enough income to hit those areas. So the marginal tax rate, that's the bracket that your last dollar fell into. And it's going to be different on the capital gains, qualified dividends. And those, as you can see on there, it's really identifying what is the different policies been put in place. They want certain spending to take place to keep boosting the economy. They want to see spending with capital gains investments in the US and abroad, anywhere that's getting money moving to keep investments going. So there's a little bit different outlay for those investments. And this is the long-term capital gains bracket on where the tax brackets fall right now. And a lot of people are think it's usually that 15%, but that's after the $77,200 threshold. And this is the tax map on what it looks like for that portion of it. So deductions, exemptions, and credits. The deductions and exemptions, those are things that are reducing what your overall income will be. And this is different areas of removing what that income ends up being to take you down into a lower tax bracket, avoiding taxes. The credits are taken off of the final tax bill on where you end up at. So the standard deduction is $24,000 for married and $12,000 for single. And a lot of the examples that I'm going to go over are for married filing jointly. That's what the clients that I work with on a daily basis, we're seeing that most often, but overall, whether it's head of household or filing single, the strategies, the ideas behind it all work the same. I'm just using the most common examples as these come up. Now, this is something that changed. This exemption is no longer there. Because they raised where that threshold was, they took away some of these itemized deductions. So the vast majority of people, it's going to be over 85%, don't do itemized deductions because the credit is already big enough without adding in those different deductions. Now, these are some of the credits. The healthcare tax credit, that was a part of the Obamacare plan, the Affordable Health Care Act. Let's take a look at an example of how these work. So if you had the gross income, married filing joint, $38,000, you take away the standard deduction, plus you get $1,300 per individual of that household, of that married couple, once you hit age 65. So that's a big step that gets added in, as you may have hit Social Security and started taking that at 62, but this is an extra exemption that comes in at 65. The IRA deduction, and then you're taking that and lining it up with income subject to tax, $94,000 at the 10% tax rate. And it's showing where you're going to fall along the line here. The deductions are going up until, if you don't go over that with where you're filing for your taxable income, there's no taxes paid. And really, if we're looking back to when some things were set up initially, that's how Social Security was put into place. back when FDR instituted Social Security, it was never meant to be taxed. But I'll mention that again a little bit later as we see some things have changed on there, where some of those different points have came in and where the changes have added when we've needed different amounts of money or the government decided it's not always just changing the thresholds, but where the deductions are falling within those thresholds, how they phase some of them out and start taxing areas that were previously not taxed. So how many of you are familiar with required minimum distributions? So quite a few of us are. What I want to know is, if anybody looked at, do you know when you first turned 70 and a half? When do you have up until, when's the due date to take that first distribution? Any guesses on during that? Well, it's not the year that you turn 70 and a half. They give you a little bit of buffer that first year when you turn 70 and a half. You have until the next year, April 1st. So go figure, it's April Fool's Day, but I don't know why they come up with that as a date. It just has to be something confounded when the government's doing public policy on it. But that's April 1st, and do you know what it is then once you're 70 and a half that following year, when you're 71? It actually goes back to a normal, it resets onto December 31st. So from there going forward, you have no more additional grace period. It's going to be December 31st for every year after. And if you wait that first year until April or sometime the beginning of the year, say you turned 70 and a half in 2018, and you waited until 2019 to do that first distribution, whether you forgot or that was part of your plan, you take that out, you're also going to have to take another one for your second year's distribution by December 31st. So it's something to keep in mind where you may end up taking two distributions within that same year if you've waited until April, beginning of 2019 for those. So in this example right here, if you missed taking out your $18,248, you would have to still take that out and pay a $9,000 penalty. You can choose which account you want it to come from. It doesn't have to be evenly split between all 5 accounts. You could pick one account to do the whole disbursement from. You can mix it up across accounts. Usually that's where you're reviewing it and saying, which ones are performing where I like them right now, and what other ones would it be to an advantage to move that money somewhere else and take it out of that account. Yep, so back on the chart, if you take more out, if you're only required to take 18,000 and you took 25, it doesn't carry over. You'd still be at the next 26.5 bracket going forward. They don't, yeah.
And of course, that money will always be taxed too, right?
Yes. Yes and no, depending on where you're falling within that threshold. So there could be an opportunity if what you're getting in Social Security benefit maybe didn't push you in there and there's a little bit of room. I have an example where I'll show that too, where you can see as it moves closer and closer, there's some opportunities there to take some pre-tax money out tax-free and avoid that just by doing that planning. The Social Security is taxed based on your other income. So if you just had the Social Security alone, no other income sources that you're pulling from, you're not going to have taxes on those, but it's pulling in other things. Your ordinary income, if you're still working and have Social Security, dividends and capital gains, and then non-taxable interest. So all those combined together are going to be what pulls it, and I'll show you, so the single or the joint, these are the thresholds, 32,000, up to that, 50% of that is taxable. When it gets over the 44,000 bracket, 85% of the Social Security becomes taxable. What I'll show in this example here is it'll show where it can start pulling some of that Social Security into a taxable bracket that would have otherwise not been taxed. This example, we're showing the 20,000 of Social Security with a 40,000 IRA withdrawal. So you have 50% of that 20,000, so we add that to the 40 and we have 50,000 provisional income. Minus the threshold, there's $18,000 then that 50% of that is taxed. Then we look at what the additional portion is over the 44 threshold is $6,000, And the reason why it's showing it's taxed at 0.35 or 35% is you've already gotten taxed on the 50%, so that's the 50 minus the 85% bracket that it falls into. So the taxable benefit, the total Social Security benefit, ends up being equivalent to a 55% of it being taxable. To where if you didn't have this IRA distribution or at that amount, it wouldn't fall into that bracket. It wouldn't have as much or any of it become taxable. That's what we show in the second example here. So now the numbers are just flipped. 40,000 in Social Security with 20,000 IRA distribution. So half of the Social Security plus the IRA, we're at $40,000 provisional income. And that's where we get 8,000 at the 50% is 4,000, and there's nothing over that second threshold because it was under 44,000. So the total taxable benefit would be $4,000, which is 10% of the Social Security. This is going to be an outline of how it would look running down the return. So taxable Social Security income, other income, total taxable income. So it's a whole convoluted calculation of how it's all put together just to find the Social Security piece of it, and then you're looking at what your other taxable income is. Minus the deductions, so it's $24,000 plus $13,000 for each spouse when they're over 65 years old. This gives us the net taxable income, $24,500. So that's what the total tax becomes. In our other side, because we had less of the IRA and more of it was Social Security, it ends up flowing through without having any federal tax on that portion. Effective marginal tax rate. So what amount on your last dollar are you actually losing Uncle Sam, the IRS, the Treasury, where the money is going? It's not just where we looked at, am I in a 12% bracket or 15%? It's going to be everything together, and where that next withdrawal, say it's the next IRA distribution, that extra $1,000 maybe ends up being taxed at a lot higher amount because of where it's pulling in some of those other sources of income. Again, the long-term capital gains shown on the tax map. I'm going to show a case study here, go through an example on here, and then I'll switch and show you how to utilize the software on a real life scenario of going through, adding a little bit more, and how those calculations start to change the numbers. So we have $60,000 of combined Social Security income, $15,000 of long-term capital gains, $45,000 required minimum distribution. What jumps out at you on this slide? 49.5%. You're thinking, whoa, what happened? I was at 22%. All of a sudden, I've jumped way up here at over almost 50%. Well, here's what you would think should happen. Taxed at the 10% or the 12% threshold. What actually happens is, this is where I mentioned you start pulling in other areas because your accumulative amount, everything together, pulls that Social Security into another bracket. You have your taxable Social Security at 12% and capital gains in this scenario. So you add those three together, and it's $499.50 you're paying on every additional $1,000 withdrawal you do within that threshold. So that's where there's a big opportunity for planning. Had you had some flexibility on, maybe I'm coming up to the end of the year and I want to use some money from savings and start my next distribution in 2019. And this is where you don't see it all the time. A lot of these calculations, again, if you're using TurboTax or a CPA is helping plan, it's all going on in the background, and you don't know until it's too late because you're doing the planning in the next year, in 2019, when the distributions have already happened. Now, right here is where I'm going to switch over and show you what the software looks like. I think we have a good enough internet connection in here, and then I'll jump back to finish up that portion of it. Take advantage of the different accounts. And again, we talked about IRAs, maybe some conversions of IRAs into Roth IRAs. There are contribution limits during the working years, but there is not on the conversions. You have that opportunity. You've already met that IRA money, for example, with the contribution limit. You can do the conversions, take that as taxable, convert it, take the taxes, pay the taxes on it now, and then let that money continue to grow within the IRA into the future if you'd like. But just knowing that there's different sources to pull that money from. Now, to review, what we've been going over on here is I go through these different steps of the taxes and how those things have affected. Again, I said I was going to go back to what things have changed. When Social Security first came in, when FDR instituted Social Security, it was never meant to be taxable. Then in 1982, does anybody remember who was president in 82? Reagan. Reagan decided that we needed, and this is where we see it's not always the thresholds, it's some of the areas that weren't taxed before become taxable. Decided we had to make up some of the tax revenues, and that's where he added the first part of it, where 50% of the Social Security on higher earners could potentially be taxable. And then in the 90s, who was our president? Clinton. Clinton added the second tier to that, to where now over the next threshold, 85% is taxable. So as we've seen, those things can change across any political dynamic, but really it's planning and just knowing what's happening this year might be different than what's going to happen next year, almost guaranteed to be different. And these are little areas that you can save on those taxes falling within those different areas. And where do we go from here is scheduling the complimentary appointment. That's where I could create the tax map for you. It's a 2-part workshop, so it's still everything is the second portion of the educational workshop is meeting one-to-one, printing out the tax map so you can have a copy. It's a 10 to 12 page report on what that looks like. And that's the planning piece, is what happens, scheduling a follow-up. What will you learn that's new? It'll be the specific strategies, how your exact numbers look within the different areas of income. We only touched on 2 of them today. How long will it take? It takes no longer than an hour. What should you bring with? You don't have to bring anything with. I would recommend tax returns, any statements that you want to see, any other accounts that you have that you want to get included. The more accurate we can make that tax map for you, the more benefit that you're going to have from it. So if you're just taking that tax map and utilizing it then on your own in the future, you have as most accurate information as possible. And again, I don't try to sell anything. It's a follow-up to the workshop. It's just strictly educational on that portion of it. And how will you feel when it's over? You'll feel happy and smart. Happy that you got the information and you started planning the tax efficiencies and the best strategy for your family, and smart that you're realizing what areas now going into the future you're not losing unknowingly and unnecessarily with how you're planning the taxes. And where do we do it? We could do it back in my office. I have an office in Big Lake. We can do it online over the computer, webinar, and really it's anywhere that works for us. We can coordinate another location that works, so we have some flexibility there. And the next steps, I want to make sure that you grab the evaluation form and turn that at the end. Mark on there, yes, if you want the follow-up information. Give me a review on the information you received. What would happen if we meet? There's 3 possibilities. We like each other, we decided we want to talk strategies and start working on a plan right away. We like each other, we decide it's not the right time and we'll follow up in the future at another time. Or we don't like each other, we swear at each other, and you run out of the room screaming. This is one of my favorite quotes around taxes. Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes. So that was from a famous judge back in 1934. This is what you'll get with a one-to-one meeting is a printout of the customized tax map. And here's a couple of reasons on why we shouldn't meet. If you're already satisfied with your taxes, if your CPA uses tax forward planning, if you already have a retirement plan. Now that, I would ask, a lot of people say, yeah, I got a retirement plan. And I said, great, what does that look like? I got a 401k, an IRA, a pension. Those are all ingredients. That's not a plan in and of itself. It's how are those coming out? When are you utilizing them? How do you get the most benefit out of them? If I am more interested, this means I can't be more interested in your finances, in your personal economy than you are. You have to be the one that is most interested and takes ownership of caring and wanting to know how to benefit and have the efficiencies going forward. And at the end there, kind of a note, if your brother or sister is already a CPA, you work with them, a tax advisor, you're probably going to them and listening to their advice only. Not all the times that's best to have a family involved, but this would be maybe one reason why we don't. If they're already somebody that's your trusted advisor, why we should meet. You want to minimize taxes and optimize Social Security. We have a whole other presentation that I worked through just the Social Security piece of it on some of those questions that were coming up. Do I take it at 62? Do I wait? And that is a personal to your family, to your household on where does everything fall and what do you want that plan to look like in the future. And if there's any doubt in your mind, there's a reason you're here, you want to get more information, but if there's something missing in your current tax plan and you want more one-to-one personal details on that, follow up with me. And again, I can't be more interested in your retirement plan than you are. I work with clients every day, and this is what I see, planning and different strategies and processes. But when I'm working with couples, even after our first introductory tax map plan, it might be 4 or 5 times within that first year just to get an entire understanding of what's going on. Because if you try to add it up and think about what am I bringing with all these, if you think back to qualifying for a mortgage and they ask for everything, it's similar to that. If we don't know what's going on when we're working with you, we can't build it as efficient as possible. The tax map's going to be missing pieces on there. And that is where I am ending with our slideshow today. So we have a little bit of time. We can follow up and do one-on-one questions afterwards. But again, grab this yellow one, drop this off with Adam at the back, and we'll follow up from there. If you just want to write down a date and time, it just kind of mentally puts you into that next step of planning and committing to a meeting. We can always change it in the future. And again, thank you again for coming out. Have a good afternoon.